Assalamualaikum warahmatullahi and salam sejahtera. Okay, now it's time for me to explain about MFRS 137, that is on provisions, contingent liabilities and contingent assets. Okay, this is the coverage, okay, for this topic. First, we're going to look into the definition of provisions and contingent liability. Okay, followed by the difference between provision and contingent liability, recognition of provision that gives rise to liability, the accounting treatment for provision and contingent liabilities, okay, contingent assets, the definition of contingent asset, okay, recognition of contingent liability and contingent asset, and finally the disclosure requirements of provisions, contingent liability and contingent asset. Okay, first of all, okay, what is the meaning of provisions? Okay, provisions can be defined as liabilities of uncertain timing or amount. Okay, so basically provisions refer to the liabilities, okay, but with uncertain timing or amount to be paid, okay, by an entity. Okay, next, okay, what is the difference between provisions and other liabilities such as accruals and payables? Okay, basically both provisions and liabilities refer to the obligations that require a future settlement. Okay, however, provisions can be distinguished from other liabilities such as accruals and payables because there is uncertainty about the timing or amount of the future expenditure required in settlement. Okay, for other liabilities such as accrued expenses, okay, and payables, the timing for settlement and the amount to be paid are certain. For example, accounts payable may be paid by a company within 1 month, or perhaps 2 months or 1 year period, depending on the terms and conditions of the contract. The amount payable by the company is also certain, as it is already stated in the invoice or in the contract. Okay, however, for a provision, the timing for settlement and the amount to be paid by the company are uncertain. Okay, these will depend on future events, such as a court decision or a warranty claim by customers. Okay, this one is about the difference between provisions and contingent liabilities. Okay, as mentioned just now, okay, provisions refer to liabilities with uncertain amount and timing. All right. Okay. However, for a contingent liability, the element of uncertainty extends further. Okay, that means for a contingent liability, okay, the timing for settlement and the amount to be paid by a company is more uncertain compared to the provisions. Okay, the existence of a contingent liability depends on the occurrence or non-occurrence of a future event. Okay, let's say a company is currently facing a lawsuit. Okay, the possibility that the company will have to pay for the claim depends on whether the company wins or loses in the case. Okay, I will explain further about the contingent liability in the next slide. All right. Okay, next, this one is about the recognition of provisions. Okay, basically, a provision shall be recognized as a liability in the SOPI and as an expense in the SOPO when 3 conditions are met. Okay, the first condition is that an entity has a present obligation, whether legal or constructive, as a result of past event or known as obligating event. Okay, the second condition, it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Okay, probable outflow of resources, okay, meaning that there is more than 50% chance that the company will have to pay out the money. Okay, and the third condition is that a reliable estimate can be made of the amount of obligation. Okay, so in order to recognize a provision in the financial statements, it must meet all the three conditions. Okay, if all of these conditions are not met, no provisions shall be recognized in the financial statements. And a liability that does not meet the recognition criteria of a provision is a contingent liability. Okay, so if a liability does not meet all these three conditions, okay, so it should not be recognized as a provision, but it must be disclosed as a contingent liability in the notes to the financial statements. Okay, next, okay, this one is about present obligation. Okay, as mentioned in the first condition just now, okay, in order to recognize a provision, okay, there must be a present obligation, okay, as a result of past event. Okay, present obligation can be classified into legal obligation and constructive obligation. Okay, legal obligation is an obligation of which its settlement can be enforced by law or contract. For example, warranty obligations, okay, as stipulated in the sale agreement, okay, or legal obligation to clean up contaminated land, okay. And the second type of present obligation is constructive obligation, okay. Okay, excuse me. Okay, constructive obligation refers to an obligation that derives from an entity's actions through its past practice, policies, or statements have indicated to other parties that it will accept and discharge the obligations or responsibilities. Okay, for example, a company has a published environmental policy explaining that they always replant trees to counterbalance the environmental damage created by their operations. Okay, so here, even though it is not required by the law, okay, the company still has a present obligation since the company has a published policy, okay, to replant the trees, or it has been the company's practice for so long, okay, to replant the trees after it has locked off a certain area. Okay, next, this one is about past event. Okay, just now, okay, in the first condition, it also mentions about the first condition also mentions about past event. Okay, so past event that leads to a present obligation is called an obligating event. Okay, if an entity has experienced an obligating event, it has to settle the obligation regardless of whether the obligating event is legal or constructive. Okay, for example, if the entity has polluted the environment, it has to pay the penalties. Okay, here the present obligation is paying the penalties. Okay, and the past event was polluting the environment. Okay, paying of the penalties is unavoidable. Okay. Okay, next, this one is about probable outflow of resources. Okay, the second condition to be met to recognize a provision is that there must be a probable outflow of resources. Okay, what is probable? Okay, probable means more likely than not to occur. Okay, that means there is more than 50% chance. There is more than 50% chance that the entity will have to pay for the obligation. Okay, when the obligation is not probable, okay, then it must be disclosed as a contingent liability in the notes to the financial statements. Alright. Okay, next, this one is about reliable estimate. Okay, the third condition to be met in order to recognize a provision is that the amount of obligation must be reliably estimated. Okay, so in provisions, estimates of the obligations have to be made, okay, reliably. If no reliable estimate can be made, the liability will be disclosed as a contingent liability in the notes to the financial statements. Okay, next one is about contingencies. Okay, basically there are two types of contingencies. Okay, the first one is known as contingent liability and the second one is contingent asset. Okay, let's have a look at the first one, contingent liabilities. Okay, what is the meaning of contingent liabilities? Okay, according to MFRS, okay, contingent liability can be defined as a possible obligation that arises from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Okay, that means let's say a company is facing a lawsuit. Okay, the possibility that the company will have to incur any expenditures to settle the claim depends on whether the company will win or lose in the case. And this is beyond the company's control. Okay, contingent liability can also be defined as a present obligation that arises from past events but not recognized because it is not probable that an outflow of resources will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. Okay, so contingent liability, okay, cannot be recognized, okay, in the financial statement if the outflow of resources is not probable, okay, and the amount of the obligation cannot be measured reliably, okay, or the amount of obligation cannot be measured reliably, okay, if the outflow of resources is not probable, okay, or the amount of obligation that must be paid by an entity cannot be measured reliably, okay, it must be disclosed as a contingent liability. Okay, so it must not be recognized in the financial statements but must be disclosed as contingent liabilities in the notes to the financial statements. Okay, this one is about recognition of contingent liabilities. Okay, basically contingent liabilities can be classified into three. Okay, first, probable contingent liabilities. Okay, second, possible contingent liabilities, and third, remote contingent liabilities. All right. Okay, probable contingent liabilities means that there is more than 50% chance that the company will have to pay out the money, or there is more than 50% chance that the company that there is an outflow of resources. Okay, when the contingent liability is probable, okay, it has to be recognized as a liability, okay, if the amount can be estimated reliably, okay. And for the second one, okay, possible contingent liability. Possible contingent liability means there is less than 50% chance that the company will have to pay for the obligation, okay, or there is less than 50% chance that the company that there is an outflow of resources from the company. Okay, if a contingent liability is possible, okay, it should not be recognized in the financial statements, but it has to be disclosed by way of notes in the financial statements. Okay, the third one is remote contingent liability or unlikely to occur. Okay, remote means it is unlikely to occur, or there is less than 30% chance that the company will have to pay for the obligation. Okay, or there is less than 30% chance that there will be an outflow of resources from the entity. Okay, if the contingent liability is remote, okay, then it needs not to be disclosed in the financial statements. It needs not to be recognized as well as to be disclosed in the financial statements.